I'd like to spend the next few minutes talking about the Momentum Diversified Target Return Fund, the general market environment that we've experienced for the past quarter, and to provide you with an update on the fund's progress. Now, DTR has been designed for institutional investors and looks to deliver returns that are comparable to those of equity markets, but with considerably lower volatility. Now, we've just celebrated the fund's 6th year anniversary, and since launch it's delivered over 8% per annum, net of all fees, with an annualized volatility of 6.3%, which I believe is about half the volatility of equity markets. Now, our fund will allocate across a broad range of asset classes and strategies, and it's these asset allocation decisions that generally account for the majority of the fund's overall performance. We'll also look to further enhance returns by appointing the best managers across the globe to go and implement these views. Now, if I think back to markets over the past quarter, it certainly feels to me as if there are several key themes that have been playing out in global markets. It's really, firstly, the sign of an overall slowdown in global growth, divergent performance amongst the major global economies, and very different expectations for how the major central banks are going to behave in terms of their future monetary policy. And finally, the effect that a strong dollar and weak commodity prices would have on, in particular, emerging economies. That are the key themes that seem to have had a substantial impact on markets. Now, these themes all have clear implications for asset prices and are probably much greater importance to asset allocation policy than all the present geopolitical problems combined. Now, the evidence of slowing growth and a continuing surge in the dollar were clearly key factors driving markets, most notably in September. But all in all, the majority of developed equity markets were able to hold their ground over the quarter and produce weak but positive returns, although UK equity markets have ended the quarter 1% down. Now again, the strong dollar theme and falling commodity prices and very much the slowing global growth has weighed heavily on emerging markets. But I think from a sterling investor point of view, the relative weakness of sterling against the dollar has provided a useful cushion to investors. So despite the outlook, emerging equity markets actually managed to produce a positive return of 1.8% over the quarter in sterling terms. That's been helped entirely by that 5% depreciation that we've seen of sterling against the US dollar. So again, it's this theme of a diverging economic performance and hence diverging expectations for how central banks could behave that were the key factors that influenced bond markets. So I think in our view, the US economy remains on track for reasonable growth this year and next. But it's really this weakening growth that we've seen and falling inflation across the Eurozone has led the European Central Bank to a more aggressive easing program. Recently, it's taken its main refinancing rate down to minus 0.2%, negative 20 basis points, and they're targeting an increase in its balance sheet of €1 trillion. And similarly, we expect the Bank of Japan to maintain its exceptionally loose policy for years ahead. So in that context, it's really hardly surprising to see that European government bonds have remained the outstanding asset class of 2014 to date. The European bond market, I think, has returned about 10.5% in local currency terms year to date. So against this broad backdrop, the DTR fund has ended the quarter 0.1% down. It's pleasing to see that there aren't any single positions or decisions that have had a significant impact on performance one way or another, but rather it was a quarter that saw a number of small contributions and detractors to overall performance. I think in terms of the asset allocation decisions that we made, our allocation to developed equity, higher quality investment grade corporate debt, and even emerging equity markets made small positive contributions to returns, but they were completely offset by exposure to convertible bonds, in which we have a 10% allocation, and emerging market debt. Now, from a manager selection perspective, most of the managers that we employed to implement our asset allocation decisions gave us returns that are in line with benchmarks, but it was really the managers that we used to gain exposure to global equity markets that struggled against their benchmarks. So that provided another drag to performance. Now, after a number of meaningful changes to the portfolio early on this year, we didn't see that it was necessary to alter the portfolio positioning this quarter. Certainly with the weakness in high yield credit and emerging markets, We'll be closely monitoring these markets with a view to possibly re-entering or selectively increasing our exposure here. Now, we've seen markets correct as they adjust to reduced growth expectations, an increasingly difficult environment for revenue growth, and frankly, the near-term prospect of the first increase in US interest rates in over 8 years. And the weakness that we've seen in markets may continue in the short term, but in my view, the search for yield and the prospect of very loose monetary policy for a long time ahead may well provide some support for markets. Look, it's important to remember that developed equity markets have performed well over a number of years now. And really, I'm thinking largely in the US, there remains a fair amount of good news that's priced into that market. So valuations are clearly not as attractive as they have been. And in some markets, particularly I'm thinking government bond markets, they remain concerning. So a degree of caution remains appropriate here. We're maintaining a moderate position to equity, but within our equity component, we've tilted away from the traditional developed equity markets towards more quality-oriented strategies. And as always, but particularly in the current environment, a healthy level of diversification remains appropriate.